2020 has been the craziest year in stock investing. Beginners in the stock market had difficulty navigating these troubled waters if they didn't know what they were doing. Now that we only have a few months left in 2022, we're going to give you 5 tips to prepare yourself for 2023 to outperform the market over the long run. Let's get right into it. Number 1. Learn the game. If I approach a total stranger who had never played poker before and ask, "Would you want to play poker with me and my friends? We'll each contribute $500. Since he had never played before and was certain to lose money, the guy would have never been foolish to accept the offer. You would be shocked at how many novice investors don't genuinely understand the fundamentals of investing if we take that and apply it to the stock market. After a year, 2 years, or 3 years, they ultimately lose money. Here are several fundamentals you should be aware of if you're new to the stock market investing game, particularly during these uncertain times. One of the most crucial indicators is the PE ratio. In essence, it assesses how much you spend for stock in comparison to the revenue it generates. Also, return on equity is a wonderful indicator for assessing how well a company generates money. Do you understand how stock market orders work? What are the market orders, stop limit orders, and limit orders? Before investing, you must be aware of these factors. How well do you understand the variety of key tactics you might use? Purchasing at a discount to inherent value is also known as the Warren Buffett technique of value investing. Are you familiar with the dividend aristocrat strategy, a collection of equities into which you can dollar cost average and outperform the market over the long run? That is, according to history. It's important that you get your head around these fundamental strategies. These little tactics that you can use and get your head around the PE ratios before you become an investor. Number 2. Invest in stocks that you are knowledgeable with. You must make investments in fields you are familiar with if you want to have an edge over other investors and receive large profits. Therefore, I advise you to stand back and evaluate the topics you are already familiar with. If you're a young man, it may be gaming, AI, social media, or a technology-related business. If you're older, you may have an edge in industries that are further along. Maybe hospitality, travel, wine, cuisine, or something like that. Buffett only picks the more established company concepts that he is familiar with, such as See's Candies, which offers sweet products. Their business model is well established and Buffett is aware of it. All the things like insurance, which Buffett spent a lot of time trying to understand. He is so adept at the game that he can choose the businesses that make good investments, and you ought to follow Buffett's example exactly. As I said, if you're young and enjoy gaming, you probably know more than most about the firms that will dominate in the future and the booming sectors. Because of this, one of Peter Lynch's most famous statements is so obvious but so profound. You see, the majority of investors desire to earn money in every sector. Therefore, he advises, know what you own and know why you own it. They want to discuss all of their businesses with their buddies at the bar. However, they don't always stay in the fields they are familiar with. They hardly ever really comprehend what they own and why they own it. You shouldn't act like most investors because of this. Number 3. Ignore the details. One of the easiest rules to follow, but also one of the most difficult. The majority of investors are consumed by the daily and weekly news of the stock market. The problem is that every time you hear the news, you experience some sort of dopamine high. 90% of investors are now dependent on the stock market's short-term events. Although this hurts how you invest and eventually your investment outcomes, I wouldn't have an issue with it. One of the issues with focusing on the extremely short term is that you tend to miss the long-term patterns that you go through. In the stock market, they are typically little dots of a longer-term pattern that is occurring if you look at a week or even a month. Therefore, if you are a shareholder who is emotionally tied to the short term, you will base your judgment on that, which often results in lower investment returns. For this reason, Buffett advises only purchasing items that you would be content to hold. Don't worry about the daily headlines or the details if the market were to collapse after 10 years. Number 4. Know your market cycles. The next thing that you should focus on understanding is market cycles. Finding out which stocks do well throughout certain periods is what I'm talking about. Stocks in industries like capital goods and transportation technology often perform well in the early to mid-cycle of the market. Why? Transportation is increasingly necessary as a result of the economy heating up and items starting to expand. During these periods, technology stocks frequently trade for a little and have a strong potential for growth. In other words, if you wanted to invest in Netflix, Tesla, or Amazon, the best moment to do so was 10 years ago, just as the market was beginning to heat up. Well, because even in a market downturn, people still need to eat. They need toothpaste, soap, clean water, etc. So consumer non-cyclical are safer to own. They also need their health taken care of, so healthcare stocks during the latter stages also work well. This is what I'm talking about. You should be getting your mind around these concepts as a novice entering the stock market. You must be aware of when and which stocks do successfully. As the expression goes, even if you purchase a stock that is the strongest in the world, if it is poor in sector, you risk losing money. One of the reasons I enjoy following Ray Dalio is because he provides historical information and connects it to the present to help us understand where we are in the market cycle. By doing this, I can tailor my portfolio to the current market environment. Number 5. Get your feelings in check and prepare for a cash. The ability to manage emotions is one of the characteristics that will distinguish excellent investors from typical investors in these times. An analogy that Jordan Peterson suggests is like us being the dependable ones during a relative's funeral. It's crucial that we take that advice further and we apply it to investment, particularly investing in and after a market fall. You see, this is the attitude that 90% of investors adopt when their stocks increase. Then check their stocks weekly, if not daily, and they go tell their pals at the bar how much money they've earned. Their emotions are all affected by the ups and downs of the financial market. The minority of investors who do the best nevertheless are those who act in the exact opposite way from those guys. Successful investors rejoice when the value of their stocks declines because it means they may purchase more at a lower cost. They are aware that their returns will be larger if they invest in equities at a lower price in the long run. Buffett claims that you're dealing with a lot of foolish individuals in the marketplace precisely because of this idea. Everyone is drinking, making it seem like a huge casino. Buy low and sell high. Sadly, most investors act oppositely. If you're a beginner investor, it goes without saying that you probably wish you had begun 10 years ago when the market and the economy were just getting warmed up. At the end of the day, all you can focus on is the state of the markets. And the little advice I've given you will assist you in navigating waters in this particular market conditions and moving ahead. That's it for this video. I hope you learned something, and if you do, I hope you leave us a like and click that subscribe button. Thanks for watching till the end. This is your 3 Towers Investing channel, giving you the latest in finance, investment, and innovation. See you soon.